Tesla's down 4% today, and if it hits and breaks this $380 liquidity level, I would expect a fast move down to $350 or even lower. Here's why. First, the daily chart is no longer trading over the market bias. The market bias is this indicator here that is going to show you the trend, and we want to be focusing on something that is currently within an uptrend, but also showing buying pressure. You'll see as of Thursday, January 2nd, price has been trading underneath the daily market bias, using it as a resistance. The second thing is price action. Price is making lows, and then when it bounces, it's not making a higher high, it's instead making a lower high, which is an indication of weakness. Price came back down to make an equal low, and when it bounced, once again, made a lower high. For those of you who trade a lot, you will also notice that we have a head and shoulders pattern in play, which unfortunately is normally a bearish signal. And the third reason is because of this liquidity test. So this support level between $380 to $374 is called a liquidity zone because price has bounced here multiple times within that level and buyers have entered the market. Now, to most people, they would think that the fact that this level has been holding is a sign of strength, but it's actually not because every bounce has been weaker and weaker. The more times that price tests a liquidity level, the higher of a chance that price is going to break that liquidity level. The same thing applies to the upside and why we were long back in November, because price was doing the opposite of what we're doing here. Price was making higher lows with a resistance liquidity level that eventually broke out. Unfortunately, now we're making the opposite, lower highs with a support liquidity level. And the question now becomes, if this support level breaks, how low could we go? On the weekly chart, the weekly market bias is seated between $360 with a low of $330. This is normally the lowest point that price will move its way back to within a bullish trend before the next breakout. You can see that the last 2 times this happened, we actually played those breakouts and both of those bounced. Something else that you want to take note of is buying pressure, which is indicated on the BX trender at the bottom of your screen. We want to see a shift from red to green, which is an indication that buyers are stepping into the market. And at this point, the BX is still showing lower lows, which is an indication that price is most likely going to sell off to $340 or $350. Or best case, continue to compress. I'm not going to look to short this because, like I said, I think worst case, we're going to see an 8% drop, which is really not that much more from this point. But I will continue to hold off on taking a trade. I stopped trading Tesla to the upside aggressively at the end of December when the weekly candle closed with lower highs, because as we know, that's normally an indication of compression. I was selling some cash secured puts just in case we were bouncing, but at this point, I think the best thing to do is to continue to sit out, and I'm going to remain patient. If price pulls back to $340 or $350, I will look to sell cash secured puts into the market bias, which is a bullish trading strategy. And once we get confirmation of a bounce, I will look to load up on call options expiring within the next 12 to 24 months. Nvidia is up 5% today, and while short-term momentum looks very strong, the bigger time frame setup honestly has me cautious. I'm not putting a short in play. There's no way I would look to do that, but I do want to share with you what I'm currently seeing. If we look at the weekly chart, you're going to see that the market bias, which is this green trend indicator that also flips to red when we're in a downtrend, you'll notice that last time price broke underneath that market bias and had that bias turn red was back on Tuesday, the 18th of January in 2022. And once we traded under that level and held under that level, price did come up to test it, but then eventually sold off 60% within 200 days. And you'll see that as of recent, basically last week, we have broken underneath of that market bias. And now it looks like we are going to come back to test maybe $135 to $140, but price cannot reject there. If price does reject at $135 to $140, then there is a very high chance that we could actually have one of these situations where price rejects back, makes a higher low, and then sells off, creating that downward trend in the market. More important than trend is going to be structure. So let's take a Fibonacci retracement from most recent low at 103 up to most recent highs at 150. You'll notice that price just bounced at the golden pocket, which is a very good sign. So structure is still bullish. And basically that structure has to hold. If we see price just bounce off of this support level and we never break $110, then there is a good chance that price could actually just come back up, make higher highs, and that breakout could happen. But if this level breaks of $110 to $114, that's where we have issues. And so we don't want to see a push back up to fill the gap and then a further sell off. That is not a good sign because one, that's going to show weakness by making lower highs and then lower lows. But two, that would also create a head and shoulders pattern with a liquidity level here, which is really bad news. Instead, you want to see price come back up and make a higher high and then eventually a higher low. During moments of indecision on a chart like this, I will like to zoom out to the bigger time frame, and we're using a weekly chart, so that means that the bigger time frame here is going to be the monthly. Now, if we look at the monthly chart, you're going to see that we are over the market bias, so we're obviously in a bullish trend when it comes to this time frame. However, the thing that I really don't like is that last month was the first month in almost a year and a half in which we closed red on the BX Trender. The BX Trender is the indicator at the bottom of your screen that's going to show buy and sell pressure in the market. The last time this closed red was back in February of 2022, in which we dropped 53%. If we look at the time before that, price actually ended up selling off 49% and then compressed for another 392 days before the next breakout. And so I don't want to be the bearer of bad news, and there's no way in hell that I'm shorting this, and I'm not telling anybody what to do, but I will say that what we want to trade and what I want to focus on are these types of expansions and these types of breakouts. What I do not want to trade are compressions where either price is selling off or even sitting sideways, because there's better places for me to put my money. So worst case scenario, I think in the coming months, we could see price back down at $88 to $90. I do think from that point, price would bounce off of the monthly market bias. Short term, if price can actually push up, break over $150, and then flip that weekly BX green, that will be an indication that price is going to continue to run to the upside. So what am I currently doing? At this point, I'm doing nothing. I am not going to short this because we are still within bullish market structure and we are still in an uptrend. I'm not going to go long because I don't think the risk versus reward is worth it at this point, and I would rather just wait for confirmation of the weekly BX turning green, meaning that institutions are also going to step in order for me to take the trade long. So at this point, I'm just going to do nothing and focus on other setups. And for those of you who are asking when would I look to go short, well, first, I would need something like this to happen. I would need price, like we said, to come down, test this market bias, reject, and then on the next test is where we would look to go short, stop out at higher high, and take profit at lower low. Then we would have shorted here again, made a massive profit, shorted here again, and lost money to only go long once again. AMD is down 10% overnight, and it bounced a little bit today. Earnings were good. I felt the numbers were solid, but guidance did not impress Wall Street whatsoever. And you can see as the most recent screenshot, I'm currently down about $100,000. And while that is a lot, relative to our fund, it is well within our risk management parameters. And my goal of this video is to explain what I plan to do with this position, why I got into it in the first place, and more importantly, where I think AMD is headed in the next couple of weeks. The first thing I'm going to say is there is no averaging down at this point. Many traders double down, triple down, sometimes quadruple down on their losers. Instead of just managing risk, closing out a position, walking away, and looking to get back in once things are confirmed again. I'm letting this trade breathe, and I'm going to continue to keep my shares and my leaps open, but I'm not going to throw more money into a potential pit. AMD does mean a money destroyer, and it's done enough of that this year. Now, the reason I went long in the first place is because price is sitting within the smart money zone. So if we take a Fibonacci retracement from swing lows up to swing high on the weekly chart, you will notice that our optimal trade entry is basically the bottom of this golden pocket to the 0.826. This area here is called the smart money zone. This is historically where institutions normally buy because price has sold off nearly 80% of that range, but is still within bullish structure. So they're able to get something that is still bullish, but at a ridiculous discount. And you'll notice that the last time we had a setup like this and price pulled right back into that zone, we popped off of earnings and ran nearly 100%. Now, I want you to understand that just because something happened before doesn't mean it's going to happen again. And when it comes to my strategy, we only have a 63% win rate. But what's most important is your risk versus reward. In this case back here, we would have risked about 10 to 15% for a potential 100% upside. In this case here, we're risking about 13 to 20% downside for a potential 80 to 100% upside. That's why I'm okay with losing, because when I lose, I'm only losing a small portion of what happens when we win. Now, what's my game plan moving forward? The best case scenario from here is that was a shakeout. Price pushes back over the smart money zone and then runs back up to test this weekly market bias where we have rejected 3 prior times. If that happens, I will look to trim my shares and most likely roll my leap options so that I'm still exposed to the upside, but I'm taking some money off the table. What I will want to see at that point is the monthly BX actually start to make higher lows, which will show broader strength. Worst case, price comes back down and breaks $100, in which from there I will close out both of my positions. And as we said before, there is no averaging down. The only time I will do that is if I pre-planned it. If you pre-plan it and you bake that into your risk management, then fine, go ahead, average down. But if you don't and you're just averaging down basically out of scarcity and worry, then you're never going to end up in a good place. But the bigger lesson here is that losses are just a part of the game. If we go back and look at how I started last year, you're going to see that we had a $34,000 loss. My score was a 25 out of 100 with a 56% win rate, but we kept up with it. We understood that at the end of the day, losses will happen and we could have a string of losses. And if we actually look the very next month, not only do we make all of that money back, the 72,000 worst case that we were down, but we actually made a profit of 103,000. We continued with the strategy. By the end of June, we had actually been up to nearly 1 million. And then from that point, things went absolutely parabolic with Tesla and the massive leaps that we had. And we ended the year up 3.9 million. But here's the thing, right? AMD was still my worst trading stock last year. And also understand that this is not taking into account the unrealized losses that I'm currently holding. But at the end of the day, because of proper risk management and because we're sticking to the strategy, it doesn't matter. Because yes, we've probably lost out on maybe $150,000 plus now on AMD. But if we just look at Tesla last year, that's 1.7 million. That more than paid for the losses on AMD. If we look at crypto last year, that was almost $1.2 million of that profit. And so it all comes down to risk versus reward. If you guys want to learn my exact strategy, go ahead and take our free BX Trender course down in the description. The link to that course and all of our courses are completely free down below.